force, it floods me like I'm just granite. I feel all messed up, but my feet are planted. Give me a planet, I will just go there. The earth is abandoned, I see the layers. Telling the time when I gaze into the canyon.
Welcome to Looking at the Markets with David Modell. Today, my guest is Mr. David Lincoln, and he is a well-known YouTuber among the financial community. He's got thousands of followers on YouTube, as well as on StockTwits. He's well-known. Twitter, Facebook. I mean, this gentleman is all over the place. He is a former CBOE, and that is Chicago Board Options Exchange market maker. So he might be able to and willing to hopefully give us an inside view on what that's all about, as well as being a financial YouTuber as I am. And we're also going to talk about the markets and how they stand right now. So, Mr. Lincoln, finally, welcome to Looking at the Markets.
Well, thank you very much, David. I'm very glad to be here. And I want to thank you for your generosity towards me in the past. You've tweeted out a lot of my videos, and it's just, from starting from nothing to have a person that watches your videos and leaves a kind word here and there, it really, really has helped me out in the past. And I have a level of gratitude towards you. So thank you very much for doing that, David.
And you've done the same thing for me, so I definitely appreciate that. I've been slowing down on Twitter and StockTwits lately. I've done on YouTube, you can do analytics, and I've found that most of my followers are on YouTube and found me on YouTube. So, I've been kind of slowing down on that lately, but I may make a comeback. You never know. But you've been growing quite rapidly. How's your experience been? I mean, you went from just having a much smaller number of viewers, and you just exploded in the last 6 months to a year. How can you account for that, and what's it been like?
Well, it's hard. It's hard getting started. I've had a couple false starts on YouTube. I first came on there as a gamer, like a lot of people do, and you can't just show up on YouTube and be like, "Here I am, okay, everybody embrace me, and I'm PewDiePie now, and a billion people are gonna come after me." You get up, and same thing with Twitter. You get on Twitter and you tweet something out, and then you realize you don't have any followers, and so nobody tweets anything back, and so it's a little bit of a wake-up call. It's a competitive thing, YouTube, and you have to both get a little niche and also get your skills up. As you know, there's a lot that goes on behind the scenes to making videos. You're everybody at first. You're the editor, you're the producer, you're the sound guy, and you got to build your skill.
Yep.
And, in a sense, it's like you get the followers as your skill level rises to that point, and as you get more followers, you feel a responsibility to improve your content. And so it's been tough, but what ended up actually working for me is falling back on something that I am an expert in, which was the trading world. I was a professional for many years, and I feel comfortable talking about that kind of stuff, and I actually have something to offer. And so once I switched my YouTube to that, it's been a little bit smoother sailing.
Sure,
definitely.
You found your niche, which is very similar to my niche, and yet you've got your own style, your own way of doing things, which is different from everybody else. And so I know you're going to have a lot of success, continued success in this endeavor. So everybody, first of all, go ahead and check out David Lincoln's YouTube channel. You must subscribe to this. You can either just type David Lincoln or David Lincoln Finance in the little YouTube search box, or just go down below this video. There will be a link in the description. Click on that and subscribe. After you subscribe to my channel, of course, yes. And also, David Lincoln is on StockTwits. The handle is THE famous FAMIS DAVE. Am I right for StockTwits?
StockTwits is, it's just Famous Dave without the, I believe. And Twitter is the Famous Dave.
I always get those mixed up. Yes, okay. So on Twitter, it's at THE FAMIS Dave. And then on StockTwits, it's just Famous FAMIS Dave. And those will also be in the description of this video. So check those out and subscribe by all means. And check them out on Facebook as well. All right. So I wanted to get into your experience. You've experienced something that I haven't and that most people never will. As I can tell by your outfit there, you are in fact a former CBOE market maker, and I imagine market makers as the people who, well, to explain it to everybody very quickly, there's the bid price and the ask price, and I believe market makers capitalize on the difference between those two, and also market makers don't really get to choose what they trade all the time, unlike retail traders. Would these be accurate statements?
Yes, definitely. And it varies based on which exchange you're working on and what product you have. But in the very most basic sense, we're there to make a market. So a bid and an offer and a size. So I'm 150 bid at 160, 20 up. I'll buy 20 and I'll sell 20. And that's our basic function, is to give a market and a size in several products. And once we make a market, if somebody hits our bid or pays our offer, then we are obligated to trade with them. So a lot goes into figuring out what that market is, and that's sort of the science of it. But market making is it's something that there's a lot of confusion around. We're thought of as these guys behind the scenes that are manipulating the situation. We're thought of, there's a lot of confusion about it. And so I've really enjoyed trying to bring a little bit of clarity to what being a market maker is about and what we're doing. And one of the biggest fallacies about market makers is that we sort of know ahead of time what's going to happen and that we're moving the markets ourselves. When I can tell you, standing in the pit, we know as little as anyone else does. We're scratching our heads just like everyone else is. And we're, as everybody's saying, oh, the market makers are running the show, we're thinking to ourselves, those guys upstairs, the big Goldman Sachs traders or the Morgan traders, those are the guys that are running the show. So, the secret is there is no guy behind the curtain. Everybody's out there trying to figure it out. Everybody's competing with each other. And, we have good times and bad times just like other traders.
Yeah, absolutely. So are there any, I don't know, I might add the words market maker secrets to the title of this video. Are there any things that retail traders ought to know that you've seen or that you've figured out as an insider?
Well, one of the basic concepts of making markets is called price discovery. And what that is about is moving prices. And so what we try to do is, if we have a buyer, we try to move the prices. We try not to make our own opinions of things if we can help it, and we just try to move the prices. So if we get buyers, we're going to try to move prices as high as we possibly can until we get a seller coming in on the other end. So if we have buying paper, we're going to move the prices up and up. That might be raising volatility in an options series. Or it might be moving the price of an underlying. We're going to move it in one direction until we get buyers on the other side, and we're going to try to let the paper dictate what the market is for us, and we're going to kind of just stand to the side and let figure it out from the paper. That's called price discovery. And to be successful, we try to keep moving the prices. And if we're selling stuff, we try to sell it at more and more advantageous prices, and if we're buying stuff, we try to buy it at more advantageous prices. Now, that's gotten a lot more difficult in these days of multi-listing of options where we're competing with several other exchanges. It's harder to move the prices when you've got other people in the way. And
right.
Thus, the world of options market making has changed a lot in the last few years. It used to be many traders on the floor. Now it is people streaming quotes from computer systems. So a typical options market maker in equities now would be streaming 200 or 300 sets of quotes, so covering 200 or 300 issues simultaneously and using computer algorithms to stream quotes in. So it's changed a lot since I was there.
Okay. It's a whole world that I'm not privy to, and it's fascinating to hear, even though you may not be involved in it in the pit right now. It's really cool to get that insider view on it. Do you think it's even possible for people to use institutional order flow? Retail traders talking about, can we use institutional order flow or block trades or dark pool trading to base profitable trades on, in your opinion?
I think that it's very important to try to track it as best we can. And what I do is I usually use Thinkorswim right now, and I will look at time and sales in Thinkorswim and try to see what the big orders were that were trading in whatever issues I'm trading that day. And I also go to barchart.com and I look at unusual options activity, and because even though I might not be able to figure out, okay, this guy's buying it from this guy and whether this is opening or closing, it will give me some indication of what's going on. If we see volatility at, say, 150 one day, and then we see a huge order, and then we see volatility at 120, then we know that somebody came in and sold a lot of stuff. Yep. If we see, and this applies, I'm sort of a VIX specialist now, and so we'll be looking at not only VIX-related products like VXX or VIX, but we'll be looking at big orders in the actual SPX that are moving the derivatives market. My channel got a big boost on February 5th with the well-publicized collapse of XIV. All of a sudden, the whole financial world kind of focused in on our little VIX world. Yep. And it was a disaster for everybody, including me a little bit, but it was good for the channel because all of a sudden people were focused on us. And we kind of get a bad rap, VIX traders, at this point. There's been a lot of bad articles about us, and we've been blamed for some of the sell-off. And I try to dispel some of these things because, volatility has been in the market, whether there are these VIX ETFs or not. If volatility is always in the market, it's a component of the marketplace, and we're not creating volatility. We're just trying to play it one way or the other. Yeah.
I remember certain people blamed these vol shorters, vol product traders, for the 10% drawdown in the markets. Well, how about the fact that we hadn't had a 10% drawdown in the S&P 500 for 2 years? You think that might have something to do with it? Maybe it was overdue. Maybe it's just a healthy correction, and corrections do and should happen from time to time. So, I'm not into the blame game, and I know that you're not either. I'm actually looking right now, speaking of that, and thank you for bringing that up, on there's an article from dealbreaker.com. Don't know much about dealbreaker.com, but they caught my eye with this headline, which is that ProShares to castrate legless survivor of short vol blowup. Well, that's violent imagery right there. Sounds painful. And they're referring to on the Volpocalypse, which has been documented on your channel and mine as well. SVXY went down, and for those who don't know, SVXY is an exchange-traded product that is short volatility, non-leveraged. SVXY went down around 90%, and XIV, which is another unleveraged short vol product that people like to trade, I'm going to put that in the past tense because that actually went out of business. I'm not saying ProShares went out of business, but the fund did. It is now gone. So what they're saying in this article here, and I just want to get your take on this if that's okay, is that basically SVXY isn't the same anymore either. Yes, it still exists, but they're calculating it differently. It is going to be, it says basically they're reducing the leverage, which I thought that's odd because it's an unleveraged product. What exactly is going on here in your opinion?
Well, before this happened, we had SVXY, which is an inverse VIX fund. So when the VIX goes down, it goes up. And this sort of, basically, people would use this to take advantage of, well, one of the big things it had going for it was it had contango in its favor. You can't actually, as you know, but some of your viewers may not, you can't actually trade the VIX. It's just a number. It's based on it's actually, they conceal what it's specifically based on, but it's basically a strip of puts in the SPX values that come up with this number, and you can't trade it exactly. So they use futures to trade it, and so that's where they get talking about it leveraged, even though it's just a one-time leveraged thing, in that they use futures to approximate the VIX. And SVXY and UVXY are to approximate the VIX 30 days out. And so they reduced them 2 days ago from UVXY used to be a 2 times the VIX leverage fund, and SVXY was a negative 1 times fund. And now they reduced them to SVXY being 0.5 times the VIX inverse and UVXY being 1.5 times the VIX inverse. But the problem that I and a lot of other people have with this situation is that ProShares just announced this change to the formula of their ETF out of the blue and said, tomorrow we're changing the formula of our product. And, a lot of people have made adjustments after this Volpocalypse that you called it. But in my opinion, you can't just change a product overnight and say, okay, it's a different product now. Several of us have options contracts on which have a time to them. They don't expire there's options that are out 3 or 4 years in UVXY. Leap's options are out, I think, through Jan 2020, maybe 2019, but far out. And so when you change the formula, the farthest out options are affected the most because they have the most vega. Now, vega is a Greek term we use in options trading for the number of dollars that you make or lose for a 1-point move in volatility. And the farthest out options in time till expiration are the most vega intensive options. So many people had these strategies that were calculated specifically to take advantage of the contango decay associated with VIX futures. And when they go and change the formula overnight, it throws all of these calculations completely out of whack. And a lot of people, had big losses. Some people had big gains, but a lot of people had big losses right after that. And this article that you were mentioning, the guy kind of makes like some snide remarks and just kind of laughs at everybody and says like, oh, everybody's morons that had this trade on. But we had no way of knowing that they would actually change the product. And I believe this is unprecedented that somebody's actually changed a formula for an ETF overnight.
Yeah, sounds to me like they're changing the rules in the middle of the game, and it's not really fair or nice. And not that this is the markets aren't necessarily fair or nice, but we expect these funds, if they want to maintain their reputation at least, to have to utilize best practices. And this doesn't seem like a best practice. Would that be fair to say?
Yes, I mean, David, you know that you and I are in the business of taking risk, and as traders, we have to try to figure out what our risks are, and we're putting it out there. We're taking a risk, and something can always go wrong, and so I accept that. I'm not, crying over spilled milk or something. I accept that stuff can happen, but this was not a risk that we thought was even out there, that they could actually just change the formula of a fund overnight. And I didn't get hurt that badly. I was long some put spreads, and thus the put that I was long had more option premium than the put I was short, and thus I lost a little bit of money on that, because when a fund goes from 2 times leverage to 1.5 times leverage, the chance of the underlying moving far away from where it is now to a far out strike gets to be less, because you have less leverage. Right. There's less chance that these options are going to expire in the money, that are way out of the money now. Right. And thus, that's all related to the Black-Scholes model, and thus the option prices go down. So we came in the morning yesterday to prices being crushed. I mean, the April 10 puts in UVXY effectively were down 50%. And I'm talking about right on the open without the underlying having moved at all. Later in the day, UVXY was up like it was today. But there was some blood in the water. And this isn't the only time this month, as you know. February 5th, there was some blood in the water too. So it's been a rough month for some people. And I'm not here to complain or bellyache about it. I'm just explaining my opinion on things.
Yeah, I appreciate that. So once again, people should definitely check out. You've got a growing Facebook group that you recently started. I'll put a link to that in the description below this video. People should check it out, or just go to Facebook, type in David Lincoln or David Lincoln Finance in the search box. But better yet, just go to the description below this video, click on that, and come join us. It's a robust, growing Facebook group, and you don't have to just only discuss volatility products. As far as I'm concerned, you can discuss other things, but you're certainly welcome to discuss all those things. I want to talk about the state of the markets right now. I'm only invested in a few things. I got a couple of blue chip stocks, small to medium-sized positions in those. I traded a little bit of SVXY recently, but I got out of that at a small profit, and I'm glad that I did. I got lucky with that. I'm very hesitant to add to any positions right now. Moving up or down 1% on a daily basis, talking about the S&P 500, having 1% or greater moves on a daily basis is not normal. Is it too, in your opinion, is it too volatile to really safely trade anything right now?
Well, I think there's definitely opportunity out there, and this is going to become normal for at least a while now. We're in an environment now where interest rates are starting to rise. There's hints of inflation in the market, and like you said, the 1 or 2% move all of a sudden has become normal in the last couple weeks. And we had the big sell-off on the 5th, and then we kind of had some hiccups, but then we started rallying back last week. But then all of a sudden, we had the Powell testimony yesterday, and we had a pretty big sell-off today. And people are scared again. The VIX popped above 20 again, and a lot of people think that this is going to be the new normal now. Is that we're going to get bigger swings in the major indices, bigger moves, and we still haven't taken out the lows of February 5th, but if that happens, then I think all bets are off for people. But this is the market we love as traders. You kind of have to pick your points, but if you can be disciplined, and there's opportunity definitely here. Stuff is out of whack, stuff is mispriced, and people are not experienced with this kind of market, but this probably is going to be the new normal for a little while now, at least. We're off of that rally, small range rally that we were on for a while, and we're bouncing around. I think we're in a trading range right now. If we take out, once again, the lows of the 5th, then fireworks could really happen. But in the meantime, we're kind of in a trading range. So if you are an options seller and are looking to sell some strangles or straddles, it might be a good time to do so, because we're kind of in a range, like I said. We're not going up or down.
Okay, like for example, the spiders, as they call it, SPY, looks like on February, early February, it went as low as, what is that? The maybe around 255 or so. So if it breaks below that, let's say, in the next few weeks, and then I imagine that the VIX futures term structure would probably go back into backwardation. So how do you fall on the debate of if backwardation does happen, do you stay out of the short vol trade, or do you get excited and rub your hands and say, okay, and now I go in even more?
Well, I mean, we went back into backwardation today, and basically, when we're in backwardation, the edge is to the upside. The VIX is sort of pulling the futures upward towards it, and there's no advantage to being short the VIX at that point. In fact, there's arguing that there's sort of a disadvantage. I would say that we only typically stay in backwardation for about 15% of the time. And we still have the drag of beta slippage, as I call it, which is as they rebalance, the value decays a little bit to offset backwardation. I don't think that we're going to go into a permanent backwardation state. I think that as long as we don't accelerate to the downside, the markets will adjust themselves back into contango at some point. But in the meantime, it's not like it was last year where you can just short stuff and it's going to go down and take out the lows. I think it will take out the lows at some point this year and say UVXY, and stuff is ultimately going lower. So don't think that the graph is just going to turn itself around and go straight up from here. It's definitely not. We will take out the lows at some point. But in the meantime, stuff can feel free to bounce around. We could be in a heightened vol regime for 6 months. That wouldn't surprise me. I think you need to have a plan for for every eventuality so that you're not shocked, and stay small. But, experience this time and try to find opportunities, because they definitely are out there.
Yeah, they're always out there. There's always an opportunity somewhere. I have stopped the practice of shorting or selling uncovered or naked calls in volatility products. I just, after the vol apocalypse, I'm done with that. Or even just shorting shares, because that was just a 10% market correction on that and the following days. That's a normal correction. That's nothing. That's not even 2011, not to mention 2008, 2009. So is it even safe just to short a few shares of VXX UVXY at all? I mean, I've seen your interviews with Vance Harwood, Stephen Aniston, Russell Rhodes. Everybody should check out those interviews, by the way, from David Lincoln and his channel. But they've all described how high volatility regimes can really wipe out accounts, and there can be sustained volatility for a long time. Is it safe to short shares of VXX, UVXY, TVIX?
Well, I think even though it was not that big of a percentage move down in the market on February 5th, it was a huge move in volatility and volatility products. And I think that don't expect to see that big a move anytime soon. I think that now that volatility is up the VIX closed in the 20s, we're not going to see an 80% move in the futures again from the 20s, even higher than that, in my opinion. I think that the 80% rule resets the day after that big move, and it would take a huge event to actually match what happened then. So in a sense, comparatively, it is safer to short this stuff than it was the day before February 5th, because a lot of the sort of pressure is off it, and we're already kind of high up in the range. So people were definitely willing to reach from 10 to 20 in the VIX, but they're less willing to reach from 20 to 40 in the VIX, because that's just the nature of things. So for people that think that this can get way worse, I would say that that move that we got February 5th is like a once in a year move or something like that, and to think that we're going to get a second one like that within a couple weeks just doesn't seem like the odds are in that favor. And yeah, it's scary out there, but I think that I wouldn't say it's safe to short anything. There's risk in everything, but it's a risk that that I would be willing to take at these levels. I think it's definitely safer than selling stuff at 9, where the market was 9 in the VIX. There's still stuff to be done. But that being said, if you are going to sell some calls, when you do get that day when volatility comes in, trade out of them. Don't expect you're going to be able to ride this for weeks and months. If you put something on and it goes your way and you have some money, lock it in and move on. Because we've seen several moves, for example, in UVXY in one day, where you could have anything you would have done, you could have bought it, sold it, and you would have been profitable at some point in the day, and you could have taken it off. The people that are getting hurt the most are people that are being stubborn and holding on to these positions and like maybe trying to make all the money back that they lost or something. You got to stay nimble and small. And I'm happy to hear that you didn't get crushed on that day, but a lot of people got crushed on that day, February 5th. And I have followers who lost a lot of money, and I feel awful for them. It's a terrible feeling to have met these people and hear that they lost a lot of money. It's because I know how hard it is to make money. I've worked minimum wage jobs in my life before, and I know that this is a serious thing for people. And so that was hard for me as somebody who people kind of look to for advice to see people lose money. I know I didn't recommend that people do certain things, but my space is in the short volatility space, and so and people took losses, and it was a tough thing to deal with. But yeah, I think that now we will not see a spike as huge as that one anytime soon, in my opinion. Even if we take out the lows from February 5th, that was a really unprecedented event to have an acceleration of a fund and things like that. And we've seen the market adjust since then, and they've changed all these funds and stuff like that. But I think there's opportunity out there now. It's a wake-up call to some people. The easy money, what happens in trading is there's an edge. You figure it out. You make some money. It works for a certain period of time, and then it's gone. You got to find another edge. Well, maybe that just getting long SVXY and riding it out and making 140% in a year or whatever, I don't know what the exact percentage, maybe that's gone and you got to find a different way. But, we readjust and we keep going.
Yeah. I mean, I had the opportunity to interview somebody you got to interview, Vance Harwood, who said, I asked him, why not just hodl or hold on to SVXY now that it's at such a massive discount? And he basically told me, and I'm paraphrasing heavily, that if you're going to do that, at least buy some puts, protective puts. Maybe even make a collar out of it. He was amenable to that idea, to sell some covered calls to help pay for those puts, because there's still massive risk there. Just because something went from over 100 to 10 doesn't mean it can't go from 10 to 3 or something. It certainly could. There's always that risk there.
Right. And sorry to interrupt you, but if you are going to trade the SVXY or the VMIN or one of these products, you have to think of it in percentage terms at this point. So if you're buying it for 12, you have to think that, okay, well, a 20% return on my money, would get me to, let's say, 15 or something, or 16 or something. You can't expect that it's going back to 100 on the turn. It's not, Right. The same VMIN, VMIN's close 281 today, something like that. If you buy it now, if it were to double in the next year and a half, that would be an amazing return if it got back to $6. But don't think it's going to 40. Right. It's not going back to 40 this year, no matter what happens. Right. And VMIN has changed their strategy. They did things the right way by giving plenty of time. They're gonna now be kind of in between what SVXY used to be and ZIV, which is a duration that's a little bit farther out than 30 days, so it's a different product. But these things, you got to look at them in percentage terms, and don't think that they're going back to the lofty returns they were at the time, because the fact of what happened on February 5th, that particular money's gone, and the futures that traded then are gone and expired, and you got to think of it in percentage terms. It's not going back to 100 this year, no matter what happens, like I said. So if you're buying it for the first time, then you got to think of it in percentage terms. If you wrote it down from 100, that money is largely gone, and it could slowly come back, but it's not going to get to 100 even in the best conditions in the next 3-4 years. That's just the way it is.
Are there any conditions under which you would ever buy a long volatility product, such as UVXY, VXX, that kind of thing? Because if the VIX ever gets back down below 9, it's kind of tempting. What do you think?
Oh, well, that's a great question, Dave, and I'm glad you asked me that, because it's a timing thing. If you're going to get long volatility, back as a market maker, what we did was when volatility got cheap, we get a historical graph of volatility, say for, GM or something, and let's say the range was 20 to 50 in vol. Once vol got around 20, we would be buyers. If it got to 10, we would be huge buyers. But that was because we were able to lay off whatever we bought. We had option buyers coming in where we could trade in and out of stuff back and forth. But as a retail customer, it's very difficult to be long volatility at any price for any period of time and make money. Just inherent in option prices. Options are mispriced a little bit higher than their actual true value, and that's just the way it is. So, and also with a VIX product, you've got other headwinds against you. You've got, contango and this sort of thing. Yeah. I'm a decent options trader, but I am terrible at timing the market. I'm terrible at timing stocks. I'm the worst stock picker in the world. I can only do my little things that I can do. And so for me, trying to pick when to buy volatility is it's a worthless cause because I won't be able to time it right.
Right.
Some people are decent at it, and some people would have a different opinion than me on that, and would be willing to buy something at a cheap vol. If you were going to do that, I would recommend doing it in stocks as opposed to volatility products, and I would do something like buy low volatility in some like longer term options, at the money options or something like that. But volatility products have too much. There's too much drag no matter what against you. And if you get it timed exactly right, yeah, it would have been great to have bought stuff right before February 5th. But there's been a million other days besides February 5th where nothing happened, where it seemed like something was going to happen and it didn't happen. Yeah. So me personally, no, I wouldn't get long it. I never am long UVXY. I'm never long volatility. I will lay off it and have no position, or I'll be short it, but I'm never long volatility anymore. When I was in the pit, I would get long at times, but nowadays as a retail guy, no.
Yeah, and I don't blame you. I'm pretty much of the same opinion. And finally, just to branch out a little bit in terms of topics, are you into any other types of equities, such as, or just investments? Are you into the marijuana stocks, or the cryptocurrencies? What's your playground or the speculative part of your portfolio?
Well, as you know, Dave, I check out the marijuana stocks. I love your series. Yeah. Dave, if you guys don't know, has a series every weekend on the marijuana stocks. But I was into it before even your series. I don't partake myself anymore, but back in college, I was a big pot smoker. I followed the Grateful Dead around the country for many years. I've been to 63 Grateful Dead concerts, and I was a judge in the Cannabis Cup in Amsterdam one year. Ooh. So I was a big smoker, and I was big into legalization back then, and Bob Marley and all this stuff. But and so it's intriguing to me that you could actually invest in something, without being a drug dealer, that was actually pro marijuana. Yeah. But the marijuana stocks, I've been following them, and there's been a setback in the last couple of weeks where Canada seems to be moving back the date, and it's a very volatile industry, and they've been getting hammered for the last while. I mean, last couple of weeks, I look at marijuanaindex.com, and they seem to operate as a whole group at a lot of times. And so even if you get good news in your stock, if the industry is going up or down, that's going to dictate what happens. It has been what I've noticed. But I think that they are long-term are going to be a huge buy. When I interviewed the chart guys, Dan, he said that marijuana stocks will make many millionaires, and I agree with that. So if you can time a good entry point in some of these, my favorite ones are Afria and Canopy Growth. Yep. And if you can time a good entry into these ones, like Afria now I think was trading, it was up today, but around $10. And they are going to be huge in the future, I believe. And so long-term holds definitely, but when you see them rip to the upside like they did in December, you might not want to, it's just like your interviews with Rich TV. You don't want to be buying stuff at a premium when everyone's buying it. You want to be buying stuff at a discount. You want to look and say, wow, that's really down. I'm going to buy some here. And I think the marijuana stocks are there right now. I lay off the cryptos. I've been outspoken. I think that cryptos are going lower. I don't think Bitcoin will reach 15,000 again. I've been wrong the whole time, so don't trust me on these, because I've been wrong the whole time. But I don't think it's ever going to get back to 15,000. I think blockchain is very interesting and is an important technology, but I think the actual value of crypto should not be so elevated, and that they're going lower. So we'll see what happens, but my prediction is Bitcoin doesn't really get too far away from this 10,000 level, and a lot of the other ones disappear.
Interesting.
For what it's worth.
Okay. All right. And we're not in the business of predicting here, but nope. But that's an opinion that I have not heard recently. So that's really interesting. And you know what? You heard it here, folks. And if he turns out to be right, then you're a genius, right? Isn't that how it works?
You can hold me to it. I don't know. I don't know if that's the way it works. I don't like to make predictions. I never predict what's going to happen the next day. Do you have a lot of people ask you what's going to happen the next day in the markets?
Yeah, I'm sure you get emails every day. I do. And I'm not in the business of predicting. And any trading or investing strategy that I do is prediction free. Anytime you go long a stock, you're predicting it's going to go up at some point. But I'm talking about specific events. Is this stock going to go up tomorrow or in the next 5 minutes? I try to avoid that. And I'm sure you do too, because we know how that usually turns out. Yeah.
Yeah. It makes you look silly in the end because on any given day, up or down, it's pretty random as I don't believe in technical analysis. I look at charts, but I don't believe at all in technical analysis, I think that's a very common trait for options market makers. We generally trade delta neutral, which means flat. We're not either biased to the up or down, and
Right.
we generally have a quantitative approach. I know my charts. I certainly know my charts, but I don't put a lot of stock in a lot of the technical analysis stuff, which I know that dismays a lot of traders. But I respect traders. If any way you can figure out to make money in these financial markets, power to you. It's just for me, it doesn't work.
Well said. All right, that's a great way to end this. So once again, people need to check out all the links in the description below this video for Mr. David Lincoln. Subscribe to his YouTube channel. Check out all of his interviews, all of his videos. Join his Facebook group. It's growing. And you'll be starting, you'll be on the ground floor of a community that is growing, and it's like a study group. It's really cool, and no charge. It's free. At least right now it's free. And check out Famous Dave on StockTwits and The Famous Dave on Twitter. Hope I got it right. All right.
Yes, you did.
All right. Well, thank you. Well, you interviewed me, and so the least I could do is repay you the favor. And I'm going to put this out and promote it, and I want people to check out Famous Dave all over social media because he is becoming the Famous Dave, and you saw him here nice and early in his journey. Thanks a lot, Mr. David Lincoln, for coming on Looking at the Markets. Appreciate it, sir.
Thanks for having me, Dave. Talk to you soon.
I didn't plan it, I cannot stand it. The brightness, it floods me, I am just granite. I feel all messed up, but my feet are planted. Give me a planet, I will just go there. The earth is abandoned, I see the layers. Telling the time when I gaze into the canyon.